The Alpha Horizon. Thinking different. Acting aware.
Welcome to Algebris' podcast. Today we have Antonella di Chio, Deputy Head of our NPL business.
Hi, Alex.
Antonella, tell us a little bit about this asset class. Fascinating asset class, and there's plenty of it. So give us a sense of what this asset class is about.
NPL stands for non-performing loans, but actually it includes a broad definition of different categories. So we start with past due, which are exposures which have not paid for more than 90 days. You have then unlikely to pay, which are exposures for which the bank think it's unlikely a full recovery of the credit. And then finally, you have bad loans, which are exposures towards borrowers which are insolvent.
And how big is this asset class, and who owns this asset class, in particular the Italian one?
The Italian NPL space is the biggest in Europe. It's more than 20% of the total NPL stock on European banks. In absolute terms, it's 340 billion gross, of which more than 50% now is outside banks' balance sheets.
How many banks do you have in Italy?
In Italy, we have about 450 different banks, so a huge number.
And how do you find NPLs amongst these many banks?
It's key for us to be local in this space, both at origination, because you need to be sure to have the best access to deals. And we experienced that a lot of interesting deals comes under exclusive negotiations, especially with smaller banks.
So take me through an example of buying an NPL. What is the pricing? What is the thought process that goes into it?
Obviously, for us, the key guarantee, the key value is the real estate guarantee. So we start with that. We start by pricing that one. So just to give you the average number for us, the real estate market value is 80 cents on the dollar, so 80% of the gross book value. Given that, we expect to recover between 55 to 60%, and the discount being usually an auction discount, which reflects the stressful situation where the real estate asset usually is. And given the 3 to 4 years average time to recover, we get to the 40 cents on the dollar as a price over the gross book value, and hence on a net basis between 10 to 12% IRR.
Okay, deep discount. How come you do it better? Why don't the banks do it themselves?
You need to be specialized. You need to have some expertise which are outside the core business of banks, which is borrowing money to lend money. So you need to have a focus on that. You need to know very well all the judicial procedures. You need to know very well the real estate market. And you need to spend time and have a lot of human capacity to do that, which banks do not.
So essentially a judicial arbitrage. You're buying at a deep discount and you're doing it better than the banks. Are you just doing the judicial arbitrage? Is this just courts or other ways of making money without going to court?
Especially in the last years, with an increase in the unlikely to pay space, where we've been one of the first buyers in this, we have seen a dramatic increase in the voluntary strategies, which is a strategy which allows you to find an agreement with the borrower and avoid the long judicial process. And usually you find an agreement with him such that he has the right incentive to agree with you a sale price of the asset. And so it's a win-win for both of us.
Local understanding, judicial arbitrage, deep discount, knowing the banks, and having a fully aligned special servicer. How is this all going to change, or is it, under COVID?
We expect the COVID to have a positive impact on the NPL opportunity set in Italy in the medium to long term. Key reason being an increase in supply. On the one hand, we expect to have more NPLs on banks' balance sheets, and we estimate between 40 to 50% increase in NPLs. On the other hand, we will likely see more secondary market transaction where the most levered players will likely come out into the market and will see the sales strategy as a way to accelerate collections given the slowdown in recovery activity driven by COVID.
Why are you focusing on the residential-backed NPLs rather than the broader categories?
The NPL space includes a lot of different risk-return profile. And among these, we think the secured is definitely the most interesting one. Key reason that at the end we have a real estate asset behind that we buy at big discount. And especially in uncertain scenarios like this, we think this becomes a valuable strategy to earn interesting returns, but at the same time having an important capital protection.
So better risk-adjusted returns for this space. Antonella, thank you very much.
Thank you, Alex.
The Alpha Horizon. Thinking different. Acting aware.